The fundamental laws of commerce were suspended on Monday. In every business school on the planet, the first commandment of capitalism is simple. If a customer stands before you with cash in hand, you take it. Revenue is oxygen. But as of January 19th, that logic no longer applies to the American precious metals market. We have received what can only be described as a distress signal from the largest bullion retailer in the United States. This is not a marketing update. It is a declaration of a broken system. Effective immediately, the primary gateway for physical silver has slammed its doors on the small investor, instituting a mandatory minimum order size that effectively bans the average citizen from protecting their savings. When a business turns away 50% of its transaction volume, it is not optimizing service. It is triaging a casualty. To understand the gravity of this move, you must look past the corporate euphemisms. When a retailer imposes rationing, and make no mistake, a minimum order requirement is the textbook definition of rationing. It signals that they have lost control of their inventory velocity. They are drowning. The infrastructure designed to move metal from the vault to the mailbox has fractured under a strain that the public was never meant to see. By prioritizing the whales and cutting off the minnows, the largest player in the game is circling the wagons. They are slowing the bleed of physical assets leaving their possession because they no longer know if or at what price they can replace them. This creates a terrifying bifurcation in the market. We are witnessing the separation of the retail lifeboat. If you have significant capital, you are permitted to board, albeit with delays. If you are a small stacker attempting to trade dying paper currency for real money 1 ounce at a time, you are being pushed into the water. This $500 wall is merely the first defensive fortification. History tells us that once rationing begins, it does not loosen. It tightens. Today it is 500. Next week it could be 1,000. The democratization of silver is ending, returning us to an era where hard assets are the exclusive domain of the aristocracy. The catalyst for this lockdown is a statistical anomaly that defies the deflationary narrative. While the mainstream media speaks of cooling inflation, the internal data from the bullion sector reveals a panic of historic proportions. We are seeing volume spikes of 400% on days when the markets are theoretically closed. This is a digital bank run. The American public, reading headlines about mint suspensions and tariff wars, has decided that waiting until Monday is a risk they cannot take. They are not buying because the price is attractive. They are buying because they fear the asset will cease to exist. This is the Giffen good paradox in real time. Demand is rising specifically because the price is rising, fueled by the existential fear of scarcity. However, the most critical revelation is not the demand shock, but the supply collapse. Hidden within the executive communication is a smoking gun that explains the entire crisis, a 50% reduction in production output. For a company that owns its own minting machinery and controls its own labor force, cutting output by half during a demand mania is irrational, unless they physically lack the raw material to feed the machines. This is not a labor shortage. This is a famine of silver grain. The industrial feedstock required to cast coins and bars has evaporated, leaving the presses silent. The question is, where did the silver go? The answer lies thousands of miles to the east. The arbitrage gap between New York and Shanghai has blown out to unprecedented levels. When silver commands a $9 premium per ounce in China compared to the United States, the global flow of metal obeys the laws of physics. It flows to the highest bidder. Refiners are faced with a simple choice: sell grain to American mints for a discount, or cast kilobars for the Asian market and capture a massive profit. The United States is being drained. We are being starved of raw material because the paper price in the West refuses to acknowledge the physical reality of the East. This creates a feedback loop of destruction for the retail market. The dealer cannot secure grain because the refiners are bypassing them. Consequently, the dealer refuses to pre-sell inventory. The standard practice of locking in a price for future delivery has been abolished because the dealer has zero visibility into the supply chain 30 days out. They cannot sell you a bar today because they do not know if that bar will exist next month or if it will cost them double to acquire. The futures market, for all intents and purposes, has been severed from the retail experience. You can now only buy what physically sits on the shelf, and the shelves are being stripped bare. As the primary market for new bullion fails, the pressure shifts violently to the secondary market. This is the moment where junk, silver pre-1964 constitutional coinage, transforms from a nostalgic collectible into a primary monetary instrument. These coins require no refining, no minting, and no industrial feedstock. They already exist, but Gresham's law is now operating on steroids. Bad money is driving out good. The public is spending their digital digits in paper notes as fast as possible to hoard physical silver. The supply of constitutional silver is vanishing into private vaults, likely never to return to the open market at current price levels. We are rapidly approaching a peer-to-peer reality. As the corporate dealers run dry and impose higher barriers to entry, the market will decentralize. The spot price on the screen becomes irrelevant fiction, a ghost number that buys you nothing. The real price is what your neighbor demands. The real price is what the local shop requires to part with their last tube of Eagles. We are returning to a handshake economy, where the holder of the metal acts as their own central bank. The window has not just closed, it has been bricked over. The 50% production cut and the rationing protocols are the final warnings. The system is signaling that it can no longer convert fiat currency into hard assets at the current exchange rate. The logistical bandwidth has snapped. For those waiting for a pullback or waiting for normalcy to return, the data suggests that the only thing returning is a harsh lesson in scarcity. The inventory is finite, the demand is vertical, and the mechanism of distribution is breaking down before our eyes.